Investors, I forgot to warn all our followers that I was taking a few days off in New York City late last week, and most years, when I do this in February, the markets sell off hard. Well, looks like history repeated as the S&P 500 sold off in a near straight line down last Friday, over 100 S&P 500 points, or almost 1.75% on weaker economic data and higher consumer inflation concerns. The worst data point last week was University of Michigan's survey showing that consumers' long-run inflation expectations rose the most in nearly 4 years to the highest level in almost 30 years. We've discussed this near exact same economic weakness and ongoing slowing fast trend 2 to 3 weeks ago in our behind the scenes, what many on TV won't tell you, the economy is slowing fast video, giving numerous reasons, including the ending of the Biden fiscal stimulus sugar high, as well as the increased uncertainty and economic concerns of the Trump Doge programs causing increased unemployment and dropping consumer sentiment and retail spending. Take a look at the updated chart on the 2-year real-time real interest rate. As we've mentioned for the last few months, down and to the right means we're growing, but slowing fast. As you can see, there was a summer peak last year in growth expectations, right as the Biden fiscal spending plan peaked in front of the election, and it's been down ever since, slowing until late December when the rate of descent picked up steam. Yes, it's most likely that this rapid slowdown in growth has been caused by the weekly Trump administration shock and awe policies, usually on Thursday afternoon or Friday, on tariffs and government job firings. Whether one agrees with these policies or not, from an economic perspective and from a stock market perspective, they cause short-term uncertainty for our U.S. consumer-led economy, and spending slows along with corporate investment plans. These plans usually slow until companies know that the set of rules are set and won't change week to week. At the same time that growth forecasts are slowing, real-time inflation expectations have steadily risen since the Trump administration took office. Take a look at the 2-year real-time break-even inflation rate chart. I guess it took me leaving town to New York for others to show their concerns and sell stocks hard at the end of last week. Also, a trend we've previously mentioned happened time and time again under Trump 1.0 after 2017, when the GOP moved beyond a tax cut agenda to many other priorities, often announcing them on Thursday afternoon or Friday near the end of the week. As we've previously mentioned, soft landings in the economy do not guarantee no volatility in the stock markets. This time around, the Trump administration seems to be going for the early shock and awe, which financial markets do not relish. The good news, investors, we're quickly getting oversold and, historically speaking, nearing what is normally a low in both economic growth expectations in the first quarter and a seasonal low in the stock markets, and yes, a seasonal high in inflation concerns. Investors, as we previously discussed historically and seasonally, February tends to be a lower return, higher volatility month for stocks, particularly in the first year of a presidential term. 2025 is proving this statistic true once again, and maybe a combination of tariff actions and Doge government firings are this year's excuse. I don't know. Take a look at the historic data on monthly seasonality from Steve Setmeyer's data group at Bank of America Securities. As you can see, while February has historically been down for first year of a presidential term, that down has historically been the best buying opportunity till late summer and preceded 5 to 6 straight months of positive returns in stocks. Historic data, of course, there are no guarantees, but since our team coined the term the old normal back in late 2022, yes, stock markets have performed quite normal ways versus historic economic cycles which we are mirroring. Soft landings, however, rare they are. For now, it's been a bull market. We're in a bull market, and however choppy things appear on your TV screens, we advise you to continue to run with the bulls, and that's the bad news for the bears. Investors, know that regardless of the path the economy and the financial markets take over the next few months, the investment team here at Oak Harvest will be here crewing the ship and adjusting our models where we can. We expect 2025 to be a very active year for active stock management. Until next week, have a blessed weekend.